Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
A wild start to the week in financial markets. Russ Koesterich of BlackRock joins us now for more. Russ, a big change, a U-turn from the President of the United States. Does it make you more bullish on equities or on bonds?
I'd say right now it makes us cautious. Good morning, Jonathan. We have been pulling in risk for a while. Clearly yesterday was a relief. Market took it as such, but as I was looking at a report this morning, you often get these big rallies during periods of turbulence. Our view is that you're still in an environment where policy uncertainty is heightened. You're also in an environment that wherever you came into 2025, whatever your economic assumptions were, they've got to be lower today. So if we've got a world of higher uncertainty, probably higher volatility, slower growth, you've got to adjust the portfolio accordingly.
Russ, in the past, that would mean going to bonds. This time around, is that still true?
Well, we have been raising our allocation to bonds. We're underweight, as you might remember, over the last few years, we've been talking about it, generally modestly underweight bonds, particularly on the long end of the curve. We've been bringing that back closer to benchmark. And I'd say that is more of a reflection of the economic environment than trying to make a bet on policy. Now, if you do have an environment where growth is going to be slower, it's not crazy that your bond allocation is going to be closer to home. But by the way, we've done a similar thing in equities. We brought our equity allocation down closer to benchmark. So, what's happened, generally lowering the risk in the portfolio in this type of environment, rather than a strong bet on you want to be in bonds and equities, you want to bring risks down.
Maybe the larger question is U.S. assets versus ex-U.S. assets at a time where the source of volatility is the United States, and this has to do with bonds, but more broadly with dollar-denominated assets. Does it make you rethink some of what you have in your portfolio based on where the source of volatility has been coming from?
This is a great question. I think this is actually a harder question to answer, but what I would say is I don't think you'll have a knee-jerk reaction to move away from dollar assets. Couple of points. First of all, we might remember 2011 during the debt ceiling crisis. The U.S. gets downgraded, the epicenter of the crisis. What happens? Treasury bonds go up. The dollar is still the reserve currency. We can debate what's going to happen in 5 or 10 years. It is still a safe haven asset. And I do think that you've got to be skeptical about calling the end of dollar dominance. The other point on the equity side, we are still modestly overweight the U.S. Now, why would you do that with all the turbulence going on? Simple answer, we still find better companies in the U.S. We think about what do we want in this environment? We want profitability. We want companies that can generate consistent earnings. Still find more of those companies in the U.S. rather than Europe or Japan. So to my mind, even with the turbulence, from a bottom-up perspective, still an argument to be modestly overweight the U.S.
Given all the uncertainty, even whether or not Trump decides to blank, walk off the cliff, give these reprieves, do you still like gold?
We do like gold. Again, I think you have to trade around it. It's been a huge move. We like gold back 6 months ago. We definitely like it today. Couple of reasons. First of all, Anne-Marie, as you suggest, still a asset that works during times of turbulence. You look at the performance of gold when volatility is rising. And again, I think it's safe to say we're probably in a more volatile environment. Generally does very well versus stocks. The other argument is the long-term fiscal picture. One of the reasons we like gold is you can't print more of it. It is a store of value. It's still not obvious that there's going to be a significant improvement in the fiscal picture. If we are in an environment of these $2 trillion structural deficits, they're not necessarily going away. Having something that you can't increase the supply, that is a store of value in the portfolio, we think that makes sense over the longer term.
Russ, just wanted to jump in with some news out of the European Union. The headline just crossed on the Bloomberg terminal that the EU is considering pausing counter tariffs against the United States for 90 days, in line with that 90-day pause that the president announced just yesterday. Just taking the temperature down just a bit more. this morning.
And I also think the European Union is looking around the room and saying, look what's going on with Japan. Look what's going on with South Korea. They are pushing out olive branches. They are saying they want to do deals with this president. He's come out and said you're going to get a 90-day reprieve. So why should we escalate? At this moment, maybe we should send a team over and try to de-escalate and come to a trade agreement.
The latest headline from the team here at Bloomberg that the European Union is considering pausing counter-tariffs against the United States on metals for 90 days. Russ, just to bring you back into the conversation as we take the temperature down worldwide, how close did we come to an accident in this bond market? What did you see developing in the previous few days going into the announcement from the president just yesterday afternoon?
Well, I think the bond market move was definitely something we were paying attention. And it was not just the Treasury market. You'll remember that, during the initial phases of the sell-off, credit markets were remarkably well behaved. That all started to change on Friday. We saw spreads back up dramatically. I think that gave a lot of people pause, because now it's not just a matter of growth, it's a matter of liquidity, it's a matter of what's happening with the availability of credit, and that was something that definitely unnerved investors. If you see the bond market calming down, that's definitely a development that's going to give a little bit more comfort to the equity side of the market.
Things settling down in the bond market this morning. Russ, appreciate your time. Russ Koesterich there of BlackRock. Amrita Sen of Energy Aspects writing, Trump needs higher supplies to lower oil prices in a manner that can provide a tailwind for global growth as an offset to his tariff policies. Instead, tariffs will lead to lower oil prices by hurting demand growth. Amrita joins us now for more. Amrita, welcome to the program. You made some headlines in the past few days on some very, very low numbers in the crude market. So what are you expecting now?
Well, I think the prices, or the general trajectory is still lower. I know there's been a 90-day pause. We saw a little bit of a bounce, but ultimately, if you look at the trade-weighted tariffs, reciprocal tariffs globally, on the 2nd of April, it was actually 19.1%. Yesterday, it was 26.2%, despite the pause, because of just how much the China bit has escalated. It just tells you that that is ultimately the one that matters the most when it comes to kind of global growth. Of course, it's better news for some of the countries. Some of those tariffs have been paused, but like you guys were saying just now as well, there is definitely no certainty that they will remain off. We are hearing more and more from our clients that consumer and particularly business sentiment has completely come to a stall. Nobody's investing. There's no capex investment. And we're going to see a pretty big demand hit. We've just reduced our oil demand number for the second half of the year by 450,000 barrels per day, the same for 2026. So I just don't see how oil prices are going to start moving higher anytime soon until we see the supply response.
How low are we talking, Amrita, do you think oil prices can go?
So look, the difference now versus in the past cycles is that the shale break-evens are higher. And when I was there just last week as well, I would say my biggest takeaway was that outside of the Permian, all the other basins, you're talking about like in the 60s, well into the high 60s in some basins, which are now their break-evens. In the Permian, it's in the 50s. But that is effectively the floor. The difference is it's the timing of it, right? We need to be here for one whole quarter before supply response. And the response will be significant this time around. You are going to lose a few 100,000 barrels per day pretty quickly, but it is just that timing. Like within that time frame, prices can continue to go lower. Remember, there's positioning driven. A lot of this is positioning driven, and people are just liquidating positions. So then it just becomes a number. But ultimately, the floor should be around where we are now, maybe a couple of dollars lower. But I don't necessarily see sustained prices in the 40s or the 50s. But we can absolutely test the 4 handle in the short term.
I know that OPEC Plus and Saudi Arabia says they do not target price, but given this environment you're describing, why did they go further and add even more barrels to the market?
Yeah, I mean, look, the timing of it has obviously led to plenty of rumors about, like, were they doing this on the back of tariffs or to appease President Trump ahead of his visit to the kingdom. In reality, OPEC just has its own timelines for doing things. The Saudi OSP always comes out around the 5th of the month, so they had to take the decision before that. So it was an unfortunate timing, but the decision was entirely to do with internal OPEC dynamics. As we've been saying, we have seen laggards, a couple of, OPEC as in Middle Eastern countries itself, but it's mainly Kazakhstan Kazakhstan. If you look at Kazakhstan's production, 400,000 barrels per day higher than where they are meant to be, and they are just not showing any signs of coming off. And I think that is where I worry, even for next month, regardless of price, because if this is about getting cohesion and getting the message across that everybody needs to do their bit, then it will not matter until and unless Prince Abdulaziz sees that compliance number pick up.
Amrita, let's put that into English. Basically, this is all designed to punish Kazakhstan with lower oil prices for a margin grab unless they are into compliance, and then there could be some sort of agreement.
Yes, I think long story short, that's it. And not just Kazakhstan, the few of the laggards. But yes, it's to say the cuts need to be equitable. It can't just be Saudi Arabia that carries the cuts for everybody.
At a certain point, there's also a knock-on effect that this potentially could become punitive at that kind of level for U.S. shale producers, for the U.S. oil export system that has been one of the drivers of a lot of growth that we've seen in the United States and the GDP here for the past decade. I'm just wondering at what point that factors in as well.
Mm-hmm. Well, that's what I was saying just now, right? The shale break-evens are significantly higher now, which is why I was saying that I don't see prices sustainably going below 55 to 60 or even 65. But in the short term, it could be, because even at these price levels, we are hearing from our shale producer clients that they have just stopped drilling, or they're planning to stop drilling. They could even drop rigs. You're going to see a very significant turn down in shale production very quickly. And like you said, that has, and we forget this, we tend to talk about the U.S. as a consumer nation. Production, and given how much U.S. production is a huge part of U.S. GDP right now.
Amrita, just quickly, we've seen commodities drop across the board over the past week or so. Seems some evidence that, particularly with copper, Chinese buyers might be stepping back in. Ahead of stimulus, are you seeing anything like that with crude?
We've seen a little bit here and there, but I do think right now there's just a bit more panic because it's still a moving target. They have come out with an SPR program as well, saying that we need to stockpile, but that's really from July onwards. The biggest hit is actually going to be on LPG, ethane in particular, and propane. Crude's still okay, but the physical market is actually still very strong. Even in the East, it's, stocks are still drawing, but it is really about the fear of the future.
Got it. Amrita, appreciate the update. Thank you. Amrita Sen there of Energy Aspect. Erika Najarian of UBS writing, management teams are between a rock and a hard place, as any outlook seen as quite bearish could also punish the sector. Erika joins us now for more. Erika, always good to see you.
Good to see you.
What do they tell us tomorrow morning? What can they tell us?
What can they tell us that will matter? A lot of investors are thinking that whatever they'll say, which is actually not so bad, is going to be seen as backward-looking. Now, I think there are really two things that investors are looking for. Number one, are activity levels now just permanently impaired from both the corporate side and the consumer side? So clearly we had this animal spirits economy that we really wanted to come through. And if you're a corporation, how do you make decisions in this environment, right? And so as you think about investment banking and loan growth in commercial, you would think that has to be at least delayed. Although I wonder if the equity market continues to rally, obviously not today, but I wonder if there's some deals that it's going to get pushed through the pipeline over the short term. On the consumer, American Express is not normally seen as a bellwether report, but given that 10% of Americans account for, or high-end Americans that make $250 account for 50% of the spend, all of a sudden they're a bellwether report, because if they're slowing down, that's not good for consumer activity for the rest of the year.
So the banks are the best data points we have at the moment. It's the best real-time data we'll get. A lot of people looked at payrolls and just said that's old news. When you were in touch with the management teams over the past few days, you put together a picture of where things are at currently. What are they telling you about activity at the moment? Have things slowed down?
Things are slow. If you look at the regulatory data and you catch up with the banks, commercial activity, it's slow. It's quite flat. And if you look at the Dealogic data, I mean, it's depressing. The whole capital markets renaissance is just not quite happening. But trading, as you can imagine, given all this volatility, trading could be lights out for this quarter.
Okay, hold on a second. I remember when we used to get volatility, and it was good volatility, and then it was bad volatility.
Yes.
And volatility isn't always a good thing. So is this good volatility volatility or bad volatility in terms of bank profits?
So far, again, speaking about backward looking, if you think about the month of March and think about the equity market volatility, sell-side desks are typically long volatility, so that could be good for them. Now, what makes me nervous is what's been happening to the Treasury market in terms of dealer capacity. So the key question for the month of April is, is there something going to happen? Is there bad volatility now happening in the fixed income markets that is not going to be good news for the second quarter?
So going forward, what do you think is going to potentially be the bigger driver? Is it going to be the trading side of things, or is it going to be the M&A wave that doesn't come to pass, or is it going to be deregulation, which we've seen some of, but not necessarily the full package?
So investors just never really value trading earnings much, right? It's super volatile. It's like throwing a dart on the board. Who knows in any given quarter, right? I think what they're really looking for is, honestly, any signs of credit at this point, because the reaction of banks up until yesterday really told me that investors were starting to worry about recession rather than just a slowdown in activity levels. And so how they frame that in terms of preparedness, having the earnings power to protect their capital, let's say if credit costs go up in anticipation of a tougher economy, I think that's what the market sort of needs to hear for now. On the deregulatory point, what's gotten lost in all of this is I feel like the deregulatory momentum in Trump 2.0 is actually much stronger than Trump 1.0. I mean, we went to that lunch. I mean, he started off, Secretary Bessent started off with bank deregulation at this lunch at the Economic Club in New York, and everybody just wanted to talk about tariffs. And he started off with bank dereg. But for now, until we understand, the range of outcomes for the economy, the macro volatility uncertainty will trump the deregulatory positive catalyst.
But do you even believe these CEOs when they come out and potentially say we're not going to have a recession, or we are? Goldman Sachs pulled their call yesterday after Trump came out and blinked.
Again, rock in a hard place, right? So, if you think about how banks set credit costs, they think about the future, they think about the outlook, and they're saying to themselves, well, I don't know what the outlook is, so perhaps they're going to build reserves a little bit, but you don't have an inventory of losses that are coming down the pipeline. Card delinquencies are actually flat to down, and commercial delinquent or non-performing loans are pretty flat and improving. And so it's tough, but they have to talk defensively, or else investors will think they're burying their head in the sand.
It's an important point you brought up about Scott Bessent at the Economic Club of New York, where we saw each other last, because he wanted to talk about deregulation and tax cuts, but the entire room wants to talk about tariffs, because at the moment there was all this uncertainty what they were going to do with trade. When you take the entire policies of the Trump administration, deregulation, tax cuts, and tariffs, how much more constructive is that for banks towards year end?
So deregulation is super, super constructive, right? Particularly as we start thinking about changes in the stress test, which I think could be a 2026 catalyst. I know it's not 5 minutes from now, as we like. So deregulation, I think, is a big catalyst. Tax cuts, obviously the continuation of, the Tax Cuts and Jobs Act would be, beneficial for corporate activity, but that's something that's already embedded, right? It's already baked in the base case. So just extending that isn't necessarily going to pump up activity, which goes back to trade, right? It's like the big overhang that is overshadowing everything else that's good.
So do the big banks benefit the most from deregulation and an uncertain regime where they consolidate a lot of trading volumes?
So I think that in a deregulatory environment, you get to unlock a lot of excess capital. And I think that's great. But if there's not a lot of demand for that capital other than trading, what good is it to unlock excess capital, right? And by the way, remember, buybacks tend to be very pro-cyclical. Like, if we're staring down the barrel of what we stared at last week, I don't feel like bank management teams are going to be like, I'm going to buy back a ton of stock now, right? They tend to be like, well, we're going to keep the capital, tight and excessive for a rainy day. So, we have this regulatory or deregulatory momentum to unlock the excess capital, but we need somewhere to put it. And I'm not sure it's going to be like shoe factories in Binghamton, right?
Do you think there's some pressure on them to cut costs now?
pressure to cut costs. I think it's too early. I mean, trading is great. No one is giving up on the outlook yet for investment banking. And, especially a lot of regional banks have PTSD from cutting too much in 2023. And now, they're, lost some A players, and now they're scrambling to hire even a B plus player, right? So I'm saying, so there might be some durability in costs. It's too late to use that as a lever.
So
too early, rather.
Looking across the companies that you cover at the moment, just identify a couple that you do like in a moment like this one, because this sounds tremendously bearish at the moment, but I'm sure there's some names you like.
So,
what do you like at the moment?
Counter to everything that I said, I am obsessed with Capital One. I think that, here's the tagline: cycles are temporary, but networks are forever. And buried under all of the Liberation Day chaos on Thursday was the New York Times headline that the DOJ is okay with the deal, right? And this is a once-in-a-lifetime deal for Capital One to own a debit network and a credit network. So in an environment like this, I have no idea what the macro is, or else I wouldn't be sitting here. I'd be on the beach, right? But in that case, what investors will support and like are stories where they can self-start, they can, grow earnings power in a different way that's completely exclusive of the macro. And that's what's happening with this Discover deal.
We all want to come to the beach with you. Erika, it's good to see you. Thanks for dropping by. Thanks for your time. Erika Najarian there of UBS, looking ahead to those bank earnings that drop tomorrow morning. Torsten Slok of Apollo joins us around the table. Torsten, good morning, sir. It's good to see you.
Morning.
Can I ignore all that?
Well, this is a Goldilocks starting point for the Fed, at least. I mean, the dual mandate says inflation should be 2. We moved a little bit more in that direction, better than expected. And on jobless claims, we also had a labor market that still is reasonably strong. So from that perspective, this is absolutely good news for the Fed that we did not get yet any inflation surprise to the upside. But obviously, we still have tariffs in the pipeline. And what's left on the tariff front could still add as much as 1 percentage point to tariffs over the next, to inflation over the next 12 months. So in that sense, this is backward looking, as Mike is saying. The risks are, of course, that there's now more upside coming to inflation.
So this is the issue, and it's a sequencing issue, and I'd love to get your thoughts on it. So sentiment's collapsed, basically created over the past few months. What we've started to see with CPI is just a bit of softness. That's encouraging. How long before we see the weakness in the output data, before we then see the higher prices in months to come? What comes before the other?
Well, let's think about how companies might respond to this. So now tariffs are coming. For example, if you think about Amazon, of the sellers on Amazon, 71% they source their goods in China. So one very important aspect is that it will be visible for everyone that prices are going up on things that are imported, of course, from China. So the conclusion to your question is, how do you respond to that? Do you take your existing inventory and sell that at the old prices? Do you take your existing inventory and raise the price immediately? That profile will probably be individual for different companies, depending on the competitive situation, which sector they're in, how sensitive they are to tariffs. So we just don't know yet what the impact will be and how quickly this will feed through. But we do know that higher prices are coming as a result of goods coming from China becoming significantly more expensive. So even if companies decide to sell the existing inventory at the old price, we will over time see some upward pressure on goods inflation coming from this source.
Is there a risk that we ignore this data at our own peril? The idea that actually lower energy prices are giving more disposable income to consumers to potentially go out there and buy, and that, oh yeah, it's also an offset for a lot of potential producers in the U.S.?
Absolutely. Low energy prices is very, very helpful for the consumer. But the other thing, of course, is that the whole surrounding sentiment around what's been going on is that we literally went from the last few days from nuclear winter to now back to talking about stagflation. And stagflation has these risks, of course, that you have headwinds from consumer sentiment being weak, corporate sentiment being weak. If you look at the Fed surveys for CapEx planning, they are really beginning to turn south. So companies are beginning to pull back more, likely because of the uncertainty. And let's not forget, we still have a $5 trillion net wealth effect on consumers from the stock market going down. So if I add this whole list together of weaker corporate sentiment, weaker consumer sentiment, tariffs coming, and a negative wealth effect, and on top of that also retaliation from foreigners who might be doing things to us simply because of the trade war, that brings you a fairly long list of downside risks to the outlook overall.
Which raises this issue of how we even game out the idea of inflation. why potentially are we not talking about deflation or disinflation? And I say this given the fact that we see Walmart, for example, saying that they are going to invest in price competitiveness. Basically, they're going to absorb all of the costs from tariffs. At what point could potentially the lack of demand be the main story more than inflation?
And that's why the key issue here is who is going to absorb the increase in tariffs? Who's going to absorb the price increase in goods that are coming here, in particular from China? Is it going to be consumers that will face higher prices, or is it going to be taken out of margins? Will the E in the PE ratio go down as a result of this, as companies such as Walmart, Costco, and of course Amazon begin to say, well, maybe we are going to absorb some of this? And that remains to be seen exactly. Maybe it's going to be split across corporates and across consumers. But the bottom line still is that someone has to foot the bill when tariffs are going up.
Wall Street Journal has this morning that the president privately acknowledged that his trade policies could potentially lead to or trigger a recession, but he said he wanted to make sure it didn't cause a depression. Where are you now in terms of potentially having a recession this year?
So, of course, the last few days, it was pretty clear that there would be a sudden stop in the economy where prices would go up significantly, literally on all trading partners and everything coming in. So that was a scenario where a recession was very likely, almost at 100% where we came from. Today, the recession probability is probably 50-50%, meaning we think that there is still a likelihood we will have a slowdown, but the risk is we just don't know what the response is going to be from consumers, corporates, how much will markets go down further. In particular, this wealth effect on its own. Think about how we normally talk about when the stock market is going down. We go back to the spreadsheets and say, what's the marginal propensity to consume? How do consumers react when the stock market goes down? Here on its own, the stock market down now 5 trillion so far, and of course now it's rebounding and then coming a little bit back again. That's on its own a fairly significant hit to consumers and the wealth effect for the consumer outlook.
We still don't know what the policy will be in a few months' time, including the tax code. This came from the president just moments ago, a social media post saying, great news, the big beautiful bill is coming along really well. Republicans are working together nicely. The biggest tax cuts in US history getting close.
Well, it's because yesterday they had to pull a vote to vote on the budget resolution from the Senate in the House because fiscal hawks are saying that Senate bill doesn't do enough for cuts. So what's happening this morning? Speaker Johnson, Leader Thune are having a press conference later this hour to outline a plan to get Trump's tax cuts through. The president sees this and he says, oh, look, they're working together now. This morning, they weren't working together last night.
Can they change the conversation? Moments ago, we just had CPI data. Let's bring Mike McKee back in for an update. Mike, you've had a second look. What stands out?
Well, a couple of things, John. We talked about grocery prices, and meat prices were up 1.1%. Chicken prices were up. Pork prices were up. So people will really be noticing it at the meat counters in their stores. More bad news for the president. He'd been bragging about the price of eggs coming down, but they rise by 5.9% on the month, which puts them up 60.4% for the year. Last month, it was 58%. So egg prices are going back up. Now, the China impact, perhaps. We saw furniture prices rise on the month, and that is something we get a lot of from China, up 0.6. Bedroom furniture up 2.7%. Apparel up 0.4 after a 0.6 rise the month before. Also something we do get a lot of from China. Toy prices went down, though. Maybe that's because Christmas and Hanukkah are behind us. Smartphone prices, surprisingly, go down by 1.1%. So maybe that's an inflation number that is coming but is not there yet. The big well, let me do housing because everybody follows that. Owner's equivalent rent up 0.4. That's a rise of 0.1%. So I was going to say the big thing that people are going to be watching going forward is energy prices, which were down 6.3% for gasoline. If that continues, it takes some of the edge off the food prices, and it does help the administration's case a little bit. But all in all, this is sort of a mixed report. The things that we thought would go down, airfares were down 5.4%, did go down. Some of the things we got from China did go up, and that's something that could continue with the big tariffs that they now have.
Mike, thank you for the update. Mike McKee there, following inflation data about 10 minutes ago. David Kelly of JP Morgan Asset Management joins us now for more. David, welcome to the program. How encouraging is that data this morning?
I don't really think it changes the narrative much. I think, Mike McKee was pointing out that airfares are down 5.4%. Actually, lodging, hotels and motels and so forth, was down 4.3%. So I think what we're seeing is a lot of softness in the travel industry, which I think is going to get worse over the course of this year. It is the calm before the inflation storm. We're going to get some higher inflation out of the tariffs. I mean, remember, we left the 10% universal tariff in place. That's a lot higher than anything we've seen really for decades. So that's high. And then, of course, there's enormous tariff on China, which is going to clog supply chains and push up prices too. So I think we will get some inflation there. But what I actually see in the data, looking particularly at the travel numbers, is a sort of a deflationary tinge to the economy or slowdown tinge to the economy already. So, I'm glad that the market rallied yesterday, and I'm glad that we've got rid of the worst of the reciprocal tariffs apart from on China. But I think that we are far from out of the woods here. I think that these data do sort of still suggest that there is a slowdown coming in the economy.
So the slowdown is what worries you more than the inflation, David, if I'm hearing you correctly, at a time where CPI just came in, when you strip out energy and food at the lowest level going back to 2021. Are you saying that that's really what markets ought to be focused on, both bond and stock?
Yes, because people talk about stagflation all the time, but really it's always inflation stag. You get the inflation first, and then you get the stagnation. And the problem is that with the labor supply falling away, with these impediments to trade, with cutbacks in government spending, government grants, and so forth, a lot of fiscal drag this year, I can see a lot of things that are going to slow the economy down. We'll get a temporary surge in inflation from this, but I think we're going to be left with a pretty stagnant economy afterwards. And the real question is, does that revolt in the House yesterday in terms of House members who are fiscal hawks? Is that really something or not? Are we going to have a bigger deficit in fiscal stimulus next year or not? If we have fiscal stimulus, then I start worrying about inflation again. But in the absence of major fiscal stimulus, I think people need to worry about recession more than inflation here.
Are bonds still the best bet? U.S. Treasuries in that type of scenario, recession, comes very much back on the table.
Well, yes. I mean, I think that, first of all, I think, long-term interest rates at 4.3%, 4.2% on a 10-year Treasury, I think that's fine. And I think people need, I'd be level weight in fixed income. I realize that we may have a mild recession here, but, longer term, whatever recession we have, we'll pull out of it again. And these bond yields are reasonable for the long run. I don't expect inflation to hang around the long run because, we'll get these tariffs and then tariffs just don't work and eventually we'll pull back from them, and that'll actually have a deflationary impulse in the economy. So long term, I'm not that worried about inflation. I am worried that there won't be much dynamism about the economy overall.
David, appreciate the update. I know you're busy this morning, so thanks for making time for us. David Kelly there of JP Morgan Asset Management. If you are just joining us, downside surprise on CPI. Market just kind of looks through it. Equities still session lows. We're down by 2% on the S&P 500. There is a bit at the front end of the curve. You see yields falling back by 8 basis points to 383 on a 10-year. And in the FX market, that unlocks further dollar weakness. Euro dollar through 111. We're at 111.15. Torsten Slok of Apollo is still with us. Torsten, David Kelly, calm before the storm. Focus on a growth story more than inflation. Do you agree with some of that?
Well, I'm not so sure. I mean, the last few days, the Fed has made very clear that they will also be focusing on inflation. So the real big question for them here is, do they want their legacy to be Arthur Burns or do they want their legacy to be Paul Volcker? Because if they walk out the door and have allowed inflation to be a lot higher, then of course they will have a serious risk. So I do think that this becomes a very, very important debate inside the Fed in terms of what weight should they put on the dual mandate when one side of the dual mandate says the Fed should be cutting, namely growth, and the other side of the dual mandate, inflation, said they should be hiking.
It's difficult to read minds, but based on the communication of the past week or so, do you get the feeling the weight of history is on their shoulders?
Because I do see some finer nuances between what's being said, in particular compared also with Jay Powell on Friday. Very importantly, can they get away with just saying, oh, we're going to cut because long-term inflation expectations in markets are very well anchored, because survey expectations are going up quite significantly, both in the short term and in the long term. So it really becomes a matter of where do they put their weight when it comes to inflation. Is it on actual incoming inflation or is it on some measures of inflation expectations which are well anchored?
But Torsten, you said it earlier, you have tariffs still in the pipeline. Can they do anything until they actually understand
the rules of the road?
I think they do the same calculations, of course, that the street is doing in terms of the impact on inflation is between half and a full percentage point higher over the next 12 months. Then I do think that they come to the conclusion that the forecast is saying inflation is going up, and therefore it's going to be difficult for them to signal a lot of rate cuts. So that's why the market currently pricing 3 cuts. It does make sense that we have a modest amount of cuts, but not more than that, even if growth does start to slow down more meaningfully.
Do you have a sense of how close they were to intervening with the Treasury market yesterday?
I don't know the answer to that, but I do know that they bought $100 billion during COVID, of course, in March of 2020, every single day in the Treasury market. And I do guess that they were probably worried that they would have to take out some of the same tools if this were allowed to continue. So if both it was caused by Japanese sellers, if the sell-off in rates was caused by risk reduction in asset managers, and if it also was caused by the basis trade unwinding, that combination and the fact that we don't even know which of these things were most powerful just still created a significant amount of risk to financial stability if this were allowed to continue.
Do you think people are trying to drift away from dollar assets? Do you see that building over the past week?
I don't see that because the dollar would have gone down a lot more in the last few days than it actually did. So there are some discussions around maybe China or others were selling in custody holdings and just kept the money in dollars and didn't sell it and took it back home. But nevertheless, the fact that the dollar index just moved relatively sideways, the yen did appreciate, suggesting that it's correct that there might have been some Japanese sellers. But broadly speaking, the DXY index on my Bloomberg screen was relatively flat for the last few days, suggesting that this was not a questioning about U.S. exceptionalism. I still think the U.S. is exceptional, still the most dynamic economy, still the biggest financial market. We still have, of course, a lot of investors that are looking here to come and invest, and that does make sense. We just have, at the moment, some turbulence, of course, that people are thinking about, that this is probably mainly viewed as a short-term quibble in markets.
I hope you're right, Torsten. Well said. It's good to see you, as always. Torsten Slok there of Apollo.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.